We all know the deal with retirement savings, right? The federal government gives you a nice tax break now so you can save, and you just pay taxes on it later when you retire. Simple. It's so standard, in fact, that 48 states play by the same rules. But then, there are two states, Pennsylvania and New Jersey. They just decided to go their own way. And in doing so, they've created this really unique and frankly often costly tax trap for their residents. And that is exactly what we are going to break down today.
So, that leads us to the big question, the one we're here to answer. If you're a tax pro with clients in PA or Jersey, you've probably banged your head against the wall over this. Why on earth are your 401k contributions taxed by these two states right now, when they're supposed to be deferred for federal taxes? It just seems backwards, right? Well, the answer is buried deep in their state laws. And believe me, we are going to unpack it.
Okay, so here's how we're going to tackle this. First, a tale of two states. Then, we'll dive into Pennsylvania's Pay Now system, followed by New Jersey's really interesting hybrid model. After that, we get into the nitty-gritty with the W-2 reporting trap. This is a big one. Then, basis recovery and audit defense, super important. And we'll wrap up with portability and the key things you absolutely need to remember.
All right, let's kick things off. Section 1, a tale of two states. Look, to really get why Pennsylvania and New Jersey are so weird, you first have to understand the federal system, the baseline that pretty much everyone else follows. These two states aren't just slight variations. They're operating on a completely different philosophy of what income even is.
So here you have it, the two models side by side. The federal deal is pretty straightforward. Defer, defer, defer. Don't worry about the tax today, we'll deal with it in retirement. But PA and Jersey, they completely flip that script. They say, nope, we want our tax money now. The second you contribute, you pay state tax. And that simple act creates something called a tax basis. Think of it like a receipt for the taxes you've already paid. And let me tell you, holding on to that receipt and being able to prove that basis decades from now, that's the whole ballgame.
Okay, on to Section 2. Let's dig into Pennsylvania's Pay Now system. It's often called the grand bargain, and for good reason. The deal is, you pay a strict upfront tax on every dollar you contribute to your retirement. But, and this is a big but, in return, you get a massive payoff when you finally retire. The whole thing is built right into the state's constitution.
So what's the legal justification for this? Well, it all hinges on this one idea, the Constructive Receipt Doctrine. See, the feds say, hey, if you can't touch that 401k money, you haven't really received it yet. Makes sense, right? But Pennsylvania's logic is totally different. They argue that the instant you earn that dollar, it's yours. You have control over it. Deciding to put it in a 401k instead of your pocket, that's just you making an investment choice with money you've already constructively received. It sounds like a small difference in legal theory, but trust me, it changes absolutely everything for taxpayers.
And here's the why behind that legal theory. It's all about this number, 3.07%. Pennsylvania's constitution demands a single flat tax rate for everyone. To keep that rate ridiculously low, they have to cast a really wide net for what they consider taxable income, or compensation. If they started letting people deduct 401k contributions, it would punch holes in that system and violate their uniformity rule. So, the simple solution? Just count it all as compensation, period.
And make no mistake, this rule is not a small thing. It applies to pretty much everything. Your 401k, taxed. A teacher's 403b, taxed. A government worker's 457 plan, you bet, taxed. Even the federal thrift savings plan. If you live in Pennsylvania and you put money into one of these, you're paying PA tax on it that year. What's wild is that even traditional IRA contributions aren't deductible, which basically makes them act like a Roth IRA as far as the state is concerned.
Okay, practitioners, lean in for this one because this is absolutely crucial. While your contributions are taxed right away, any money your employer kicks in, like a match or profit sharing, is not taxed. This is so important. It means inside one single 401k account, you're essentially tracking two different buckets of money. Your after-tax dollars that create that precious basis, and your employer's pre-tax dollars, which have a basis of 0. Keeping those straight is everything. All right, let's head over to the Garden State for Section 3, New Jersey's hybrid model. And folks, if you thought Pennsylvania was a little quirky, just wait. New Jersey's system isn't just complex, it's a genuine patchwork. It creates totally different tax situations for people based on nothing more than the type of retirement plan they happen to have. So how did this mess happen? This timeline lays it out perfectly. Before 1984, New Jersey was just like Pennsylvania. Simple, everything was taxed. But then the legislator tried to get with the program and align with the federal system. The problem? They wrote the law in this super specific, narrow way.
The new tax deferral rule applied only to Section 401k plans, and with the stroke of a pen, they created this weird divided system that we're still dealing with today.
And here's the crazy result of that 1984 law. If you work for a company and have a 401k, you're golden. Your contributions get deferred for NJ tax, just like the federal government wants. But what if you're a teacher with a 403b or a public employee with a 457 plan? Too bad. Your contributions are taxed immediately. Tax pros have a name for this. It's called a horizontal equity failure. It's a fancy way of saying it's just not fair. You can have two neighbors, same income, same savings, but one pays more in state tax just because they're a teacher instead of a corporate manager.
Okay, moving on to Section 4. Now we're getting into what is probably the single most common and honestly most dangerous pitfall for taxpayers and preparers alike. I'm talking about the W-2 reporting trap. A tiny little mistake on this one form is the number one thing that triggers those dreaded automated notices and audits.
This table lays it out so clearly for Pennsylvania. For your federal taxes, that 401k contribution is taken out of your wages in Box 1. But for Pennsylvania, it's the exact opposite. Your payroll department has to add that money back into your state wages in Box 16. It's not optional. And that one little add back is the reason your state wages are higher than your federal wages.
So here's the bottom line. The thing you have to burn into your brain: for a PA employee with a 401k, Box 16 has to be bigger than Box 1, period. If they're equal, the W-2 is wrong. And this is a huge problem with big multi-state employers who might not know PA's weird rules. Their payroll software messes it up. And you can bet the Pennsylvania Department of Revenue has its computers programmed to look for this exact error. It's an instant red flag that triggers an automatic audit notice for underreported income.
Which brings us to Section 5, Basis Recovery and Audit Defense. So you've been a good soldier, paying taxes on your contributions for decades. Now what? The big question is, how do you make sure you don't get taxed again on that same money when you finally take it out? The answer is all about recovering your basis, and knowing how to do this is your number one defense when the state comes knocking.
Now, both states let you get your basis back, but they do it in different ways. Pennsylvania is pretty simple, especially for early withdrawals. They use a cost recovery method, which just means you get to take out all of your own after-tax money first, completely tax-free. You only start paying tax when you've exhausted your basis and start dipping into the earnings. New Jersey, on the other hand, has this really interesting 3-year rule for their plans like 403bs. Basically, if your pension payments are big enough to pay you back your entire basis within the first 3 years, then all your payments are tax-free until that basis is recovered. It could be a huge tax saver for new retirees who qualify.
And that's not all for New Jersey. On top of getting your basis back, they also offer a pretty generous pension exclusion. But, and you knew there was a but, look at that eligibility rule. Your New Jersey gross income has to be $150,000 or less. And this isn't a phase-out, it is a hard cliff. If you make $1 over $150,001, poof, the entire exclusion vanishes. This makes planning your income in those first few years of retirement in New Jersey incredibly important.
Okay, so what happens if your client actually gets that audit letter? Listen up, because this is the playbook. The state starting position is always the same. Your basis is 0. They assume you've paid nothing. The burden of proof is 100% on you, the taxpayer, to prove them wrong. This is where you have to become a forensic accountant. You're digging up old pay stubs, W-2s, account statements from 20 years ago. You have to isolate only your own contributions, create a year-by-year schedule, and make it bulletproof. And if you find a mistake on an old W-2, you have to formally fix it, either by getting a corrected W-2C or, in PA, by filing a special form to manually fix the state wages.
All right, let's bring it home with our last section, portability and key takeaways. This is a huge one. What happens if you live in Pennsylvania for 20 years, building up all this after-tax basis, and then you retire to Florida? Can they still tax you? Understanding these moving rules is absolutely key.
So here's the fear everyone has, that Pennsylvania or New Jersey is going to reach across state lines and try to claw back taxes on your distributions after you've moved. Well, I've got good news. The answer is a hard no. There's a federal law from 1996 called the Source Tax Act that flat out prohibits this. Once you are officially a resident of another state, PA and NJ lose their power to tax your retirement income. It's a critical federal shield that protects you when you move.
You know, this quote really just nails it. It says, geography dictates the efficiency of retirement savings. And that's the whole story in a nutshell. How good your 401k is from a tax perspective has less to do with the plan itself and everything to do with where you happen to live.
And the only defense you have in this game is understanding the rules and, you guessed it, keeping meticulous records to prove what you've already paid.
This chart just says it all. Let's take a teacher with a 403B. In a normal state like New York, it works like you'd expect. Contributions are deferred. Simple. Now look at Pennsylvania. You pay tax up front, sure, but then the whole thing, your contributions and all the earnings, is completely tax-free on the way out. That's a great deal. But then, look at New Jersey. That poor teacher gets the worst of both worlds. They're taxed upfront on the contribution, and then they're taxed again on the earnings when they withdraw. It is the exact same retirement account. But depending on which side of the Delaware River you live on, you get a radically different financial outcome. It's wild.
So I want to leave you with this one thought. If you or any of your clients have ever worked in Pennsylvania or contributed to something like a 403B or a 457 plan in New Jersey, you have a tax basis in your retirement account. That's a fact. The real question isn't, do I have a basis? The question is, can I prove it to an auditor? Are your records good enough to survive that scrutiny? Because let me tell you, when that state notice finally shows up in the mail, I think so is not going to be a good enough answer.